So think about this. If you took $10,000, right, and you put it in an S&P 500 index fund back in 1980.
Okay, 1980.
Yeah, and you just sat completely still for 42 years, your portfolio would have grown to over $1 million.
Which is incredible.
It's massive. You do absolutely nothing and you earn $1 million, but, and this is the hook for today, if over that grueling 4-decade marathon, you stepped away from the market for just 5 days.
Just 5 days out of 42 years.
Exactly. The 5 best trading days out of more than 10,000. Your total drops from over $1 million down to roughly $671,000.
Wow.
You lose over $400,000 because you missed less than 1 week of action in 4 decades.
That is just mathematically brutal.
It really is. So welcome to today's deep dive. We are looking at a financial strategy breakdown from the Source Money Strategist, and it's titled, Use This Compounding Strategy and Now W to Get Rich When the Market Crashes.
A very aggressive title.
Very. But our mission today is serious. We want to equip you, the listener, with the mathematical and honestly the psychological armor needed to survive and actually profit from the next inevitable market crash.
Right, because we need to take a serious, authoritative look at how market mechanics actually work. The core premise here is really eye-opening. Most investors are going to lose wealth in the next crash.
Almost guaranteed.
Yeah, but not because the crash itself permanently destroys capital. They lose it because human beings are fundamentally ill-equipped to handle volatility.
We panic.
Exactly. People panic, they liquidate their assets at the absolute worst possible moment, and they essentially lock in their own destruction.
But then there's that small fraction of prepared individuals who do the exact opposite.
Right. They use these exact same periods of maximum economic terror to build wealth. And it has nothing to do with luck.
So what's the difference then?
It's entirely about understanding the invisible mathematics that govern market drawdowns and having an automated system in place well before the liquidity crisis even starts.
Yeah, it's like think of a market crash like a hurricane hitting a coastal town, you know? The people who didn't board up their windows, they lose their houses.
Perfect analogy.
But the prepared investors, they're the ones stepping out right after the storm passes to buy up all the vacant lots at a massive discount.
That's exactly what's happening. But before we get into how to buy those vacant lots, we really need to examine why the unprepared lose so much during the storm.
Right, the invisible math.
Yes, the source targets a concept that is practically a religion in personal finance, which is compounding.
Everyone loves compounding. Einstein supposedly called it the 8th wonder of the world.
Right, the whole snowball effect.
Yeah.
But what nobody talks about is how mathematically fragile that snowball actually is when it hits a wall.
So let's break down that fragility, because I feel like this is where the math stops being intuitive for a lot of people.
It definitely does. Compounding assumes a linear progression, right? Your capital makes a return, and then that return makes its own return.
Year after year.
Exactly. But the source points out a harsh reality called loss asymmetry.
Loss asymmetry. Let's dig into that with the $10,000 example from the text.
Okay, let's do the math.
So you have 10 grand. Year 1, you get a 10% gain. Now you're at 11,000.
Simple enough.
Year 2, another 10% gain. You're up to $12,100. You're feeling like a genius.
Right. The snowball is rolling.
But then year 3, the crash happens. A 40% drop.
And here is where people get confused.
Yeah, because a 40% drop takes your $12,100 all the way down to $7,260. You haven't just lost your gains, you've lost a huge chunk of your initial principal.
And this is where the asymmetry of losses kicks in. Because to the human brain, if you lose 40%, you just intuitively think, well, I just need the market to bounce back 40% to get even.
It feels like a 1-to-1 ratio. Just give me 40% back.
Exactly. But it's a catastrophic misunderstanding of percentage-based math. You are no longer generating returns on $12,000.
Right, your base is gone.
Your capital base is impaired. You're trying to generate returns on just over $7,000. So if you get a 40% gain on $7,260, that only gets you to about $10,000.
You're still down 2 grand.
You're still in the hole. To actually get back to your pre-crash total of $12,100, mathematically, you require a 67% gain.
67%. That is wild.
A 40% drawdown demands a 67% recovery just to break even. This is probably the least understood concept in finance.
I always think of it like climbing out of a well.
Yeah.
Slipping down 40 feet into the darkness takes what, 1 second?
Yeah, practically instantaneous.
But it takes exponentially more energy, more time to
Wow.
climb 67 feet just to reach the exact same ledge you fell from.
That's the perfect way to visualize it. Falling is frictionless. Markets can drop 40% in weeks because of margin calls and sheer institutional panic.
Right.
But climbing out requires actual economic growth. It takes years of corporate earnings, multiple expansion, massive macroeconomic tailwinds.
You need a miracle just to get back to zero.
Exactly. Which means your goal as an investor isn't maximizing the upside. It's fiercely protecting your portfolio from the asymmetry of deep drawdowns.
And that brings us directly back to that staggering fidelity data from the intro.
The 42-year study.
Yeah, January 1980 to the end of 2022. Because of this unforgiving asymmetry, we have to ask, how devastating is it when human panic interrupts that fragile compounding?
It's total devastation. The numbers are almost hard to believe.
Right. So to reiterate, leaving 10 grand in an S&P 500 index fund grew to over $1 million, but missing the 5 best days drops you to 671,000.
You lose 40% of your wealth for missing 5 days.
And it gets worse. If you miss the 50 best days over that same 42-year period,
What's the number there?
you walk away with only $76,000.
Wow.
You end up with 14 times less money over 42 years.
That is just incredible.
Yeah.
And you have to unpack the gravity of what that means for a normal investor.
I mean, it means you can't afford to step out.
Exactly. Think about it. You took on the exact same decades of risk. You sat through the exact same terrifying market drops as the person who made $1 million.
Right.
But simply because you were out of the market for less than 2 months total, spread out over 4 decades, your wealth is decimated.
It's like running a 42-year marathon, right? And you step off the track to tie your shoe for 5 measly seconds.
Yeah.
And you find out you forfeited the gold medal and 90% of your prize money. The goal isn't timing the market. The goal is never, ever interrupting the compounding.
But we have to address why people miss those best days in the first place. It's not an accident.
Right. Nobody intentionally skips the best days.
No, they miss them because they misunderstand when those explosive days actually happen. People assume massive market rallies happen when the economy is great.
When unemployment is 0 and everyone's happy.
Right. But the data shows the exact opposite. The most explosive upward moves in the equity markets almost exclusively happen in the darkest depths of a bear market.
Wait, really? The best days happen during the crash?
Yes, because of market mechanics. During a severe crash, institutional traders short the market.
They're betting on it going down even more.
Exactly. And when the market becomes deeply oversold, if even a tiny bit of less terrible news comes out, like the Fed hinting at a bailout, all those short sellers have to rapidly buy back shares to cover their positions.
A massive short squeeze.
A macroeconomic short squeeze. That forced buying triggers vertical, record-breaking price spikes.
So the person who panic sells after a big drop to, quote-unquote, protect themselves,
They're stepping out right before the short covering rally.
which provides the exact 67% gain they desperately need.
Precisely. They absorb the entirety of the shock and voluntarily remove themselves from the recovery.
That is tragic. So if staying in the market is an absolute mathematical necessity, you need to know exactly what kind of turbulence you're staying in through.
You have to categorize the threats.
Right, which the source does with a taxonomy of market downturns. We really need to normalize the drop.
Normalizing it is key because the financial media treats every red day as a completely unprecedented catastrophe.
Always breaking news.
Always. But historically, drawdowns are scheduled events. The source breaks them into 3 tiers. Level 1 is the correction.
Right, a drop of at least 10%.
And what's the frequency on those?
Very common. They happen roughly every 1.2 years since 1980s.
Every 14 months or so. So it's basically scheduled maintenance. It's just the market burning off excess speculation.
Yeah, if you've been investing for 5 years and haven't seen a correction, statistically you're overdue. It's math, not a warning.
I'd ask you, the listener, to think about your reaction to the news over the last few years. Did you ever feel the urge to panic sell during a 10% drop, not realizing you were just experiencing a totally normal reset button?
Probably. I mean, it's scary. But then there's level 2. The bear market.
This is where it gets psychologically very difficult.
Yeah, a drop of 20% or more. The source says this occurs every 4 to 5 years since 1932.
And bear markets are usually paired with actual economic pain. Job losses, high inflation, stuff you feel in the real world.
Right. But the key data point here is how long they last. They last about 289 days on average.
Nearly 10 months of grinding downward pressure on your portfolio. That duration is literally engineered to break your psychology.
But the flip side is that bull markets, the recovery and growth phases, last around 965 days.
They last 3 times as long.
Right. So the pain is short and sharp, and the growth is long.
Because panic is an event, but growth is a process. Selling takes a millisecond click. Building economic value takes years of corporate expansion.
The market falls out the window but takes the stairs back up. And
Big
then you have level 3, the full market collapse.
A drop of 30% or more.
Very rare, but incredibly severe. We're talking 2008, the March 2020 COVID crash, the dot-com crash where the NASDAQ lost nearly 80%.
Those are systemic shocks. They alter the trajectory of a whole generation.
But knowing the schedule is just theory, right? We need to know how to practically prepare our financial fortress before that 30% drop arrives.
Yes, theory doesn't stop you from panicking when your life savings are cut in half. You need structural preparation.
And the author gives us 3 actionable pillars for crash preparation. Let's break these down. Step 1, protect the foundation.
This is probably the most counterintuitive step for aggressive investors.
I agree, because the instruction is to build a 3 to 6 month emergency fund in a high-yield savings account, or HYSA, earning maybe 4 or 5%.
Right.
My first thought reading that was, why keep so much cash on the sidelines losing to inflation when it could be in the market compounding?
Because you have to look at the correlation of real-world risks. The HYSA is not an investment.
Okay, what is it?
It's insurance for your compounding. Think about what happens when the S&P 500 drops 30%. The economy is usually seizing up. Companies preserve cash by initiating massive layoffs.
The real-life emergencies, like job loss or medical issues, cluster around economic downturns.
Exactly. The probability of losing your job spikes at the exact moment your stock portfolio hits rock bottom.
Oh, wow. So if all your money is tied up in stocks...
You become a forced liquidator. You have to sell your stocks at a 40% discount just to pay your rent or buy groceries.
That is how generational wealth gets destroyed.
Exactly. The cash moat prevents you from ever being forced to realize those asymmetrical losses. It buys you the time to wait out the 289 days of a bear market.
That makes total sense. Okay, pillar 2. Automate dollar cost averaging, or DCA.
Now we move from defense to offense.
Right. And we all know the basics of DCA. You invest a fixed amount regularly. So the text gives a $200 a month example. Month 1, shares are $20, you buy 10.
Simple math.
Month 2, a crash happens, shares drop to $10, your $200 now buys 20 shares.
You're getting a massive discount.
Month 3, it recovers a bit to $15 a share. You buy roughly 13 shares. So total, you invested $600 and you have 43 shares at an average cost of about $14.
Which is fantastic, because if the market had just stayed flat at $20 the whole time, you'd only have 30 shares.
Right. But what's the advanced psychological benefit of this? Why automate it?
Because human beings cannot manually buy during a free fall. During a crash, the market is violently volatile. It drops 5%, rallies 3%, drops another 4%.
It's terrifying.
Right. Your loss aversion will paralyze you. You'll sit in cash waiting for a clear signal that the bottom is in.
Which, as we know, doesn't happen until the recovery is already halfway done.
Exactly. Automating your DCA removes human agency. It turns a terrifying wealth-destroying event into a structural accumulation phase. It artificially accelerates your wealth accumulation by blindly buying discounted assets.
It's a discount event.
Absolutely. You harvest the volatility without having to think about it.
Okay, so that leads to pillar 3. Diversify and rebalance. The text says to spread across U.S. stocks, international, emerging markets, bonds, real estate REITs.
The standard diversification playbook.
Yeah, but I want to push back on the rebalancing part. Because rebalancing means periodically adjusting your portfolio back to its target percentages, right?
That's right.
Psychologically, that feels completely backwards.
It feels inherently wrong.
It really does. The source brings up Tesla. People didn't want to sell Tesla while it was skyrocketing. Rebalancing literally forces you to sell your biggest winners to buy your biggest losers.
It feels like benching your star player to give minutes to the worst guy on the team.
Exactly. Why would anyone voluntarily do that?
Because if you don't, you lose your diversification. Your portfolio becomes dangerously concentrated in whatever sector is currently a bubble.
Like tech in the late 90s.
Perfect example. People who refused to rebalance their tech stocks during the dot-com boom ended up with portfolios that were 70 or 80% tech,
And then the NASDAQ crashed almost 80%.
and their wealth was permanently impaired. Rebalancing is forced discipline. It forces you to actually do the thing everyone says they want to do, buy low and sell high.
Oh, I see. You're locking in gains before a sector collapses.
Yes. By trimming your winners, you take chips off the table. And by allocating to underperforming sectors, you're buying assets on sale.
Okay, that makes sense mathematically. Now, really quick, I have to bring this up because it was so funny to read.
The YouTube tangent.
Yes, the original source material, amidst all this rigorous financial math about DCA and macroeconomics, just randomly suggests opening a YouTube channel to diversify your income.
It is quite a bizarre pivot.
It's totally out of left field. They even promote their own community to teach you how to vlog. I just want to be clear to you, the listener, we are impartially reporting this. We're not taking a side or endorsing the idea that starting a vlog is the secret to surviving a market crash.
No, definitely not. I mean, earning extra income is great, but a side hustle won't save you if your primary investment portfolio isn't structurally sound.
Right. So let's get back to the core issue. If these three pillars, saving, automating DCA, and diversifying, are mathematically simple, why do so many smart people fail?
Because the flaw isn't in the strategy. The flaw is in our biology.
Section 5 of the source gets into this, the biological saboteur, behavioral economics in a crash.
This is where we bring in the legendary behavioral economists Daniel Kahneman and Amos Tversky. They established the concept of loss aversion.
Right, the idea that losing money is hardwired to hurt us way more than gaining money feels good.
Mathematically, they proved that losing $1,000 causes a neurological distress that is twice as intense as the joy of finding $1,000.
Twice as intense.
Yes, it's a biological glitch.
So our brains are basically wired for caveman survival.
Exactly.
When we open our investment app and see a deep red portfolio, our brain registers that red line as a saber-toothed tiger. We try to run away, when mathematically, we should be buying the tiger.
That's a great way to put it. The amygdala takes over, logic shuts down, and you sell just to stop the pain.
And the source gives an incredible deep dive into the legendary story of Peter Lynch to prove this.
This is one of the most fascinating case studies in finance.
Yeah, from 1977 to 1990, Peter Lynch managed the Fidelity Magellan Fund.
And he delivered an average annual return of 29.2%.
Which is just god-tier performance.
It's unheard of over a 13-year period.
But, and this is the craziest part, Lynch noted that many investors in this incredibly successful fund actually lost money.
How do you lose money in an asset that goes up nearly 30% a year?
Right, how's that even possible?
It's possible because their biology overrode the math. Investors would see the fund performing brilliantly, feel greedy, and buy in at the absolute peak.
Buying high.
Then, the fund would experience a normal 10% correction. The investors' loss aversion would kick in, they'd panic, and they'd sell their shares at a discount to stop the pain.
Selling low.
They systematically bought the top and sold the bottom, incinerating their own capital while holding the greatest asset of their generation.
So what is the defense against that? If human biology is that strong, how do we win?
Willpower is not enough. The only defense is a written, premeditated investment plan created before the fear kicks in.
You have to tie yourself to the mass.
Exactly. You write down, when the market drops 20%, I will not sell. My automated DCA will continue. And when the panic hits, you follow the rules blindly.
Okay, so we've got the math, we've got the psychology, but you, the listener, need concrete proof. Let's look at how this plays out in the real world during actual historical crises.
Section 6. Historical proof.
Yes. Let's review the J.P. Morgan research and the historical crash data from the source.
The J.P. Morgan data highlights a really cruel irony about the 2008 financial crisis.
The Great Recession.
Right. 7 of the 10 best single-day returns in S&P 500 history happened during the 2008 crisis.
Wait, during the crash itself?
Yes. As we discussed earlier with the short sellers covering their positions, the volatility clusters.
So selling to protect yourself mathematically guarantees you miss the rebound.
It guarantees it.
Let's look at the 2007 to 2009 S&P drop. The market fell 57%. 100 grand became 43 grand.
A horrifying drawdown.
But the text points out that investors who continued DCAing, say, $500 a month, bought shares at $1,000 a unit during the darkest days.
Because their system was automated.
Right. And those units eventually recovered to over $3,000 a unit by 2021.
They acquired massively discounted assets because they didn't interrupt the compounding.
And it happened again in the March 2020 COVID crash, a 34% drop in just 5 weeks.
One of the fastest crashes in history.
Fast crashes caused the most panic. Those who panic sold locked in massive permanent losses. But those who stayed in, relying on their emergency funds, saw a full recovery in just 5 months.
5 months to get back to zero, followed by extraordinary gains over the next 2 years.
Which brings up a crucial, challenging question for you, the listener. If you give in to the fear, right, and you sell everything at the absolute bottom of a crash to, just wait for things to calm down.
What is your signal to get back in?
Exactly. What exactly is your signal? By the time the news anchors tell you the economy is safe again, you've already missed the recovery. The market looks forward, it recovers before the economy does.
If you wait for the all clear, you're buying back in after the 67% gain has already happened. You lock in the asymmetry of losses permanently.
It's a guaranteed way to go broke.
Yeah.
So let's impartially recap the core takeaways of everything we've gone through today.
We covered a lot of ground.
First, crashes are mathematically scheduled events. Corrections and bear markets are normal.
Second, compounding is a fragile miracle. It can be permanently stunted by loss asymmetry if you interrupt it by going to cash.
Third, success requires a physical architecture, a solid emergency fund, automated dollar-cost averaging, and true diversification.
And fourth, you need a pre-written plan to override human loss aversion, because your biology will betray you.
And remind yourself that the people who walk out of market crashes with more wealth than they started with, they aren't luckier, and they aren't even necessarily smarter.
No, they simply understood this data and prepared accordingly.
But I want to leave you with a final provocative thought, something to ponder on your own that builds on this but applies to our modern world.
This is a really important angle.
We know that emotional control is the ultimate deciding factor in keeping your compounding alive. But consider this. In Peter Lynch's day, checking your portfolio meant waiting for the morning newspaper.
You had to physically go find the financial section.
Right, there was friction. But Today, you have a supercomputer in your pocket that gamifies stock trading. It sends you push notifications every time the market drops a single percent.
The barrier to panicking has been completely removed.
Exactly. With the constant real-time trigger of loss aversion buzzing right in our hands 24/7. Is modern technology actually making it mathematically harder for you to survive the next crash?
It's a terrifying thought. The tools meant to empower us might actually be our biggest liability when the storm hits.
Something to think about the next time your phone buzzes with a market alert. Thank you for joining us on this deep dive. Prepare your fortress, automate your strategy, and don't let your biology bankrupt you.